Everyone wants a piece of AI and quantum right now. And honestly, that instinct isn't wrong. These are genuinely transformational technologies. But here's the thing nobody says out loud. The technology winning and your stock winning are two completely different things. In 1999, everyone knew the internet was going to change everything. They were right. Cisco still hasn't recovered its 2000 high 25 years later. The technology won, a lot of investors didn't. So today, we're doing this properly. I'm going to rank every type of AI and quantum investment, from the safest play to the most speculative, diving deep into both AI and quantum side of things, and at the end, show you exactly how to build a portfolio that participates in all of it without betting everything on one outcome. Before we get into any tickers, there's something worth understanding about these two sectors specifically, because they are not the same kind of bet. AI is generating real, massive revenue right now. Quantum is still mostly science with a price tag on it. That doesn't mean quantum is worthless as an investment. It means you need to size it differently. The framework that actually works long-term is this: a core of boring, diversified index funds for the heavy lifting, and a smaller thematic sleeve for things like AI, quantum, and emerging tech, sized so that if it went to zero, your retirement plan stays intact. Keep that in the back of your mind as we go through everything, because the structure matters just as much as the picks. Let's start with AI, because this is where most of the real money is moving right now. But before that, if you like more content like this, make sure to hit that subscribe button so you don't miss out on future videos like this one. And I hope you enjoy the rest of this video. AI, Tier 1, the unbreakable giants. The lowest risk way to play it isn't some startup. It's companies you already know. Alphabet, Microsoft, Meta, and Amazon. These aren't AI companies in a pure sense. They're enormous, profitable businesses that happen to have AI as a massive tailwind. That distinction is everything. Alphabet is planning $180 to $190 billion in AI-focused capital expenditure this year alone. Microsoft has already embedded AI across Azure, Office, GitHub, and Teams, and 65% of Fortune 500 companies are already using Azure OpenAI services. That's not a trend, that's a moat. And Meta is quietly one of the best AI stories out there. Its open-source Llama model strategy is gaining ground fast, and it monetizes AI improvements almost immediately through its advertising machine. Amazon has AWS re-accelerating, custom Trainium chips giving it cost advantages, and it's trading at a cheaper forward valuation than Microsoft right now. The reason these belong at the low-risk end is simple. If AI lives up to the hype, they get significantly bigger. If AI disappoints or takes longer, they survive on massive existing cash flows. You can't say that about most AI stocks. Tier 2, picks and shovels. Here's where it gets more interesting and slightly more risky. In the 1800s gold rush, the people who reliably made money weren't always the miners. It was the people selling the shovels. NVIDIA sells the shovels. Its GPUs power roughly 80% of AI training workloads globally, and its CUDA software platform is where most foundational AI code is written. That's a switching cost that competitors have been trying to crack for years. 2025 revenue came in at $215.9 billion, up 65% year over year. The caveat is that valuation already prices in a lot of good news. There's not much margin for error at these levels. Broadcom is the less talked about name in this tier that deserves attention. It's building custom AI chips for hyperscalers and handling AI networking infrastructure, the plumbing that makes everything else work. AMD rounds out this tier as the secondary chip bet, particularly as agentic AI shifts compute demand more towards CPUs, which is where AMD has established real leadership. Tier 3, high risk, high upside. Now we get to the names that make people's eyes light up and where you need to be most careful about valuation. Palantir has real AI software revenue and real government contracts. It's one of the cleanest AI software narratives out there. It's also the most valuation-sensitive stock in the entire AI space, meaning any earnings miss or slowdown gets punished hard. Next is CoreWeave. This is the closest thing to a pure-play AI infrastructure stock. Revenue went from nearly nothing in 2022 to $5.1 billion in 2025 and is expected to top $10 billion in 2026. Impressive, but it's deeply unprofitable, and 67% of its revenue comes from a single customer, Microsoft. That's concentration risk on top of sector risk. These aren't bad businesses, they're just priced where there's no room for things to go sideways. If you want AI exposure without the single stock risk, an AI ETF does the job. The Global X AIQ ETF has $7.4 billion in assets and returned nearly 30% over the past year. The VanEck Semiconductor ETF, SMH, functions as an AI infrastructure fund at just 0.35% expense ratio. NVIDIA, TSMC, Broadcom, and Micron all in one ticker. I'm planning on making an in-depth video about AI ETFs specifically, so make sure you subscribe not to miss out on that. All right, quantum. And this is where I need to be straight with you, because most videos won't be. IonQ, the strongest revenue performer among pure-play quantum stocks, generated $130 million in revenue in 2025 against losses of around $500 million. D-Wave had $24.6 million in full-year revenue, alongside losses of $355 million. Rigetti's Q4 revenue was under $2 million. The gap between the story and the actual revenue isn't a small gap, it's a chasm. And as of right now, useful commercial quantum applications are still 5 to 10 years away for most industries. That doesn't mean you shouldn't invest. It means you need to know exactly what you're buying, and it's closer to a long-dated bet on science than a traditional growth stock. Okay, so let's get into the quantum tier list. Tier 1, Big Tech with Quantum Exposure. The smartest institutional investors have figured out the cleanest way to play quantum, and it's through companies that are already profitable. Alphabet's Willow chip is making genuine breakthrough progress on quantum error correction, which is the single biggest technical hurdle in the field. IBM is on track for fault-tolerant quantum computers by 2029 and recently secured over $1 billion in CHIPS Act funding. It also has the deepest enterprise sales operation in the space, meaning when quantum becomes commercially viable, IBM is positioned to sell it faster than anyone. Microsoft is taking a different approach entirely, betting on topological qubits through its Majorana 1 chip, an architecture that could, in theory, be more error-resistant and commercially useful sooner than competitors. The reason billionaire investors have overwhelmingly chosen Alphabet as their preferred quantum stock is simple. You get a free call option on quantum becoming real, while owning one of the most profitable advertising and cloud businesses on the planet. If quantum arrives in 2029, you win. If it takes until 2035, you weren't sitting in a company burning through cash waiting for it. Tier 2, the pure plays. And now the lottery tickets. That's not an insult, it's just an accurate description of the risk profile. IonQ is the most commercially mature of the bunch. Q1 2026 revenue came in at $64.7 million, up 755% year over year, and it's available across all major cloud platforms. The trajectory is improving, but there are two things to watch. It's still running large losses, and pure-play quantum companies regularly issue new shares to fund R&D, meaning your ownership stake gets diluted as the science advances. Rigetti, D-Wave, and QUBT are even earlier stage, with smaller revenue bases. These are positions you size for a possible 5 to 10x return, while fully accepting they could go to zero. Not a maybe, an actual possibility. If you want quantum exposure without picking which company survives the decade, the ETF route is cleaner. The Defiance QTUM ETF returned over 50% in 2024 and nearly 37% in 2025, easily outpacing the NASDAQ 100 both years. The Wisdom Tree WQTM ETF is newer and more focused. It's dedicated purely to the quantum ecosystem, including hardware, software, and post-quantum cryptography, without big tech names diluting the exposure. Both are worth knowing. If you want to know more about the best quantum ETFs, you can find a more in-depth video about that on the top right corner, or I'll leave the link to that video in the description. How to build the actual portfolio. Here's how to bring all of this together. Think in sleeves, not individual picks. Start with a core of at least 50% in broad index funds, VOO, VTI, or a total market fund. This is the engine. Everything else is the turbocharger. Then a broad technology sleeve at around 15%. QQQM tracks the same NASDAQ 100 as QQQ at a lower expense ratio of 0.15%, making it the smarter long-term choice. Then an AI sleeve at 15%, one or two mega-cap names like Alphabet or Microsoft, an AI or semiconductor ETF, and optionally one higher-risk individual pick if you have conviction. A quantum sleeve at 10%. Anchor it in QTUM or WQTM, and if you want individual stock exposure, start with IBM or Alphabet rather than going straight to the pure plays. And a crypto sleeve at the remaining 10% if that fits your thesis. A Bitcoin ETF, an Ethereum ETF, or both. Here's the thing that makes this structure work. If the quantum sleeve goes to zero, and that is a real possibility, the other 90% of your portfolio is still growing. You stayed in the game. The Cisco lesson from 1999 wasn't that tech was a bad investment. It was that concentration in the wrong part of the trade at the wrong valuation is what actually hurt people. This structure protects you from that. Drop a comment. Are you already positioned in any of these, or are you just now figuring out where you fit? I read every one. And if you want to go deeper on the specific quantum ETFs, how they compare head-to-head, and which one fits different risk profiles, watch this video as well.